maybe I just give a little bit of a talk about from the entrepreneur perspective, and then also from, I understand the angel perspective is one that people are interested in.
Yeah, amazing.
Yeah, and just as way of background, I've invested in a bunch of companies in Latin America as an angel. I've also done it in the United States, and have been involved with some VC funds as well. And PuenteLabs, as a lot of people may know, was to help entrepreneurs come to the United States from Latin America and to expand their companies. So I wanted to just dive into that a little bit, because one of there's three questions I always ask an entrepreneur right off the bat, and they're the following. Do you plan to have customers in the United States? Are you going to send invoices to customers in the United States? Are your investors going to be US investors? And down the road, if you think you're going to have some sort of acquisition or M&A event, will it be a US entity? And if the answer to all of those questions is no, then there's really no reason to actually start a Delaware C Corp in the United States. But if the answer to any one of those questions is yes, then I think it's really imperative and important to have the right legal structure in place so that investors will take your company seriously. And that structure that I'm talking about is a Delaware C Corp. So one of the things that I think people don't understand is, like, sometimes you can start with an LLC and do these basic things, but if you're going to be taken seriously and raise capital in the United States, that's kind of a must. And there's a lot of reasons for that we don't need to go into. And then I think one of the misgivings that I think a lot of entrepreneurs have is some of them have never been here before. And I'm going to talk specifically about the cross-border aspect. I mean, it's different if it's in country and in region. We can talk about that too. But if you're coming to the US, a lot of times entrepreneurs haven't been here. And if they haven't been here, I suggest just come for 2-3 weeks, figure out, lay the land, as opposed to just coming and expecting to go to Sand Hill Road and raise capital. So the thing that I always say is I like to group it into groups of 30. So what I always say is try to find the top 30 angel investors that would be ideal for your company. I mean, it could be Elon Musk. It doesn't matter. Like, put together a list of 30 of who you would just dream to have as your top angel investors. Do the same thing for mentors, which I think is a little bit different, because mentors may invest, may not. It just depends. And then I think the same thing for seed funds. So literally a list of, it can be an Excel spreadsheet or Google Sheet, have your top 30 list. And then what I like to suggest is start with number 30 and work through to number 20 on your list, because your pitch is going to get better the more you do it, and you're going to get more comfortable with it. You're going to be able to articulate more clearly what it is you're looking for. And then what I like to do is, after that, go straight from 1 to 10, because then you go through the list that way. And the reason this is important is the timing is critical. So when you get a term sheet, if you're lucky enough to get a term sheet or multiple term sheets, they typically have expiration dates on them. They expire. Could be 72 hours, could be 48 hours, could be, a little bit longer. So what you don't want to have happen is you get a term sheet from someone that you don't really want to work with, but it's the only one you have. So you want to ideally have 2 or 3 term sheets at the same time, so you can compare and contrast and maybe pick whoever you think the best investor is. And then also, I think angels and mentors work well with the seed funds because they always work together. So for example, I'm often referring deal flow that I have at the early stage to a seed fund, and they know me and they like me and they perhaps work together. So think of those 3 different buckets of individuals as work with them simultaneously, because they can really help each other to do that. The other thing that I think, a lot of times, especially for technical entrepreneurs, they forget that the purpose of these meetings is just to get the second meeting, the follow-on meeting. And I think especially really technical entrepreneurs, they tend to just go into product and they just dive, really, really deep on why that. I think you have to understand that this is a process and it takes some time. On average, I think it's going to take 90 days. Typically, if you're not closing within 90 days, maybe you need to revisit and take a different approach. The good news is that all of the VCs now have blogs and they all write. So there's no excuse not to understand and know not only which firms and what the focus of those firms, what kinds of investments they make, but also the individual within the firms themselves. So you want to identify the partner or the individual that's responsible for the area that your company is involved in, because it's not enough. I mean, to be perfectly candid, I would rather have a investor person that I like a lot than a firm name with a junior associate or somebody who's not necessarily as involved in my company. So I think matching not just the names, Sequoia is not good enough. You need to know who within that firm specializes in the area that your company is focused on, read everything that they have, and really walk into that meeting just fully prepared. So, and again, what I say is, it always fascinates me that entrepreneurs will spend all of this time building product, writing code, doing Q&A, spending time on marketing. And then when it comes to fundraising, they just throw their hands up and say, oh, I'll just go and show up. It's the same thing. It's a process. You would never release a product without doing the proper QA. So it's the same thing with a venture firm. You need to make sure that the stage is the right stage, the size of check that they write is the right check, and that it's a good match, that they don't have an investment in a competitor to your company. And so you want to do all of that work up front, because once you start your fundraising process, that's when the clock starts. So you can do all of this work up front, which is why I like the 30-30-30 model, because then you can do all your work, all your homework, and figure out who to reach out to and what to do. And then, I mean, there's no real secret sauce to it. I mean, VCs basically have 5 criteria that they all use in one variety or another. I mean, basically, they're looking for 5 things: team, firm fit, the TAM or the market size, product market fit, and then what's the competitive financial landscape. And so, I mean, I'll go over those a little bit more in detail, but every VC has some sort of variation on those 5 themes. So number 1, team. Is this team credible? Does this team have the right design? A couple of things that I look for are, do they have engineering as a focus, or are they top heavy? Is it a bunch of CEO, high level executives from companies with an outsourced engineering team? That's always a red flag. Is it 2 back-end engineers with maybe a salesperson? That's better. And so they're always looking for that team. How long have they worked together? What's the drive and the motivation for doing that? How do they work with confrontation with one another? That sort of thing. Firm fit's an easy one. If they're an enterprise VC, like Santi spoke at your conference, they're an enterprise SaaS venture capital firm. You don't go to them with the next consumer app. You just don't. That's just not their fit. So that's an easy yes, no. I think TAM, total addressable market, and market size is critical. Mostly the numbers thrown around is, can this be $1 billion company, is in the Valley is sort of the margin. But I think more important is the mistake a lot of entrepreneurs make is they say, we're going to do 1% of the total addressable market. Or if I sell this same widget to every person in China, I'm going to have, I'm going to have, 1% of the total addressable market is my revenue. That's not how it works. So what is more important is to do what we call bottom-up analysis. So that's, what is your actual customer? What is your actual segment? And then develop the revenue from that bottom-up approach. So an example might be, if you're a gaming company and you run on iPads and iOS and Android devices, and you're in Mexico City, what's the population within Mexico City, not the whole population, but that own those devices? And how many of the people that own those devices are your demographic? So if it's a game for kids, it's a different number. How many of those, what's the average purchase cycle for that demographic that you have? So the more data you have, the better off you're able to extrapolate and talk about what that addressable market is. The 4th thing, product market fit. So this one's a little bit hard. I'm not talking about an MVP. I'm not talking about, the days of writing your idea on a napkin and getting funded are over. I mean, unless you're a very high profile name entrepreneur, that just doesn't happen anymore. And in fact, most of the funding that occurs is not pre-product. So they want to see what your product is. They want to see how it's working in the wild. It could be freemium, it could be consumer, it can be enterprise, doesn't matter. One of the things that we used to look for at PuenteLabs was, do you have 5 enterprise customers? And we looked for customers that were based in the United States because we were looking for a repeatable, scalable sales model that can be done not by a missionary founder, but by somebody that's been hired as the VP of sales or your sales director. So we would look for maybe one big name. It could be a market, it could be a departmental level sale, and then maybe 2, 3 startups that are smaller. But we want to see customers actually using the product so that we can get an idea of how it works and what that scale looks like. And then the other thing that I'll throw in there is, you have to have a unique insight or a special sauce or what they call it. Like, what is your insight that's different? So I'll use Eric at Zoom as an example. The insight that he had was, and he came from WebEx, the insight that I think this is correct. I mean, Santi maybe talked about it, but there was a big problem with Skype and all these other services. They were hard to install. You had to buy expensive equipment, television screens, networking. The voice wasn't always correlated. The sharing within the meetings themselves was not good. So there were a lot of fundamental problems with the existing solutions. And Zoom came along with a product that was 10 times better. Calls didn't drop. I don't know how many people we have on this call now, but they just had better packet switching, better. It was a 10x better solution. So you have to ask yourself, how am I better? Which leads to the last point, which is competition in the competitive landscape. It's okay if you're competing against Google and Apple and Microsoft. It really is. But you have to have a product that has a unique insight that's better. So Slack has been slugging it out with Microsoft, and I think we just saw in the news that it looks like maybe Benioff's going to gobble them up. But I think the point there being, Slack was much better than everything else. I mean, Microsoft was competing with them with Teams because it was free and they were giving it to their customers. But your product or your insight needs to be somewhat, I would say, a 10x margin better than whatever else is out there. And then the last thing that I'll just sort of add on the entrepreneur side is, I think especially for the engineers, and by the way, I love engineers as founders. I mean, I think I'm not dissuading that, but sometimes what they do is they build a product without talking to a customer. So they spend all this time building products that are maybe not suited for the market. And then they expect that they just hang up a shingle on their website and the sales will start coming in. It doesn't happen that way. You could have the best product out there, but unless you have a credible go-to-market strategy, both marketing and sales, it's going to be difficult to be successful. So I think and obviously I'm biased because I come from a sales background, but I think it's really important to have a go-to-market strategy that's credible and that's working at least at the beginning levels of traction, so that when you do talk to venture capital firms, they can sort of assist in certain ways. Then the last thing I'll say on the entrepreneur side is there's a great book out called The Messy Middle that came out a couple of years ago. And every single company, I don't care how successful it is, they went through hell and back. It wasn't easy. I mean, even like Corner Shop, Corner Shop, everyone talks about, oh, there's this massive Uber exit. It's a great exit for Latin America. I'm going to tell you that Oscar and Danny struggled. Not once, not twice, but like 3-4 times. And I'm not talking about the initial seed round. And I'm not talking about the original Series A or the 20 million round they did. It was a battle. Like, are we going to be able to make payroll? Did we pick the right category? And I think what people forget sometimes is that the end result in the beginning, there's a long way in between those two. So I think what investors and folks like myself are looking for is someone or teams that are really willing to just do whatever it takes to get through to that next, to the success or the finish line. Because it's hard. I mean, the average time on this is 7 to 9 years, and that's if everything goes right. So right now, then what I'd like to do is, I understand there's some angel investors as well. So what I'd like to do is maybe change and talk a little bit about on the angel side. So as an angel investor, I think I think to be successful, I think there's two generic approaches. It's what I like to call horizontal versus vertical. So, and what I mean by that is, if you're a horizontal angel, so that would be me. So I have a background in sales, and so in strategy, and so when I talk to to companies, money is really probably 10th or 11th on the list. It's not that, I mean, I'm not Peter Thiel. I can't move the needle in terms of my pocketbook. But I think where I have success from an angel perspective is I try to find companies where I can add a lot of value, and I can help them in areas where they need help that I have expertise in. And so I think what I mean by horizontal approach is, you could be a founder of a company that did well. You could be an executive at at a company. You understand operations. You understand how to hire people. You could be a developer that understands how to build product. You could be sales or marketing, any kind of what I'd call horizontal blocking and tackling skills that help companies get to the next phase. Elad Gil, who I think is one of the best angels on planet Earth, brought Twitter from a very small, 10 million to a billion in sales. So he recognizes and understands what it takes for a company to go from B to C. And so he does that over and over and over again. The vertical approach is one where it's more a domain expertise. So that would be something like, I understand the insurance industry. And there are lots of companies that are coming in the insurance industry, these startups, and I'm going to really focus on that sector, or banking or crypto or whatever it is. You understand the industry at a level, in a degree that nobody else does. So Fabrice Grinda and Jose Marin, I think, fit this camp. They were so good at the Facebook paradigm that they understood within 30 seconds of looking at an entrepreneur's pitch whether it would work or not. And the reason they understood that is they had the vertical domain expertise. And so he knew all the people, Fabrice knew all the people at Facebook. He knew all the potential acquirers. He knew all the people in the industry. He knew which types of employees would be good fits for which types of companies. So he basically could grab a company at a startup stage and supercharge them and get them to the point where they've got customers and acquisition potential and future follow-on rounds. So the point being, I mean, both of these work well. And I think the point I'm trying to make is that if you're looking to become an angel investor, I think you got to choose one of those initially. And then once you start building a track record and you start helping entrepreneurs and they start, word of mouth gets around and they're like, oh, this person's very good at this particular domain, you'll find lots of deal flow. And, the mistake I made, I know I talked about making mistakes. I've made them all. I'm a naturally curious guy. And so I've done everything from offshore wind turbines to online advertising to commerce. So when you do it like that, it takes a long time, and you have to park your ego and understand that you're never going to be the smartest person in the room. So when I'm doing an offshore wind deal, I need to talk to people that are in the space and really just have a good network. So I think if you're going to take the horizontal approach to investing, I think having a good network is very important. So I typically don't know the answers to anything, to be perfectly candid, but I can make 2 phone calls and find someone who does. So I think either way is fine. You don't have to be, if you're going to do the horizontal approach, you don't have to be the biggest expert on everything, but you have to have a good network and know who to talk to. Number 2 is expectations. There's a bit of what I would call confirmation bias in the news and the media and TechCrunch. Everyone hears about these billion-dollar exit. Tony Fadell sold Nest to Google for $3 billion. Great, but look at Google's acquisitions over the last 15 years. You'll see that the bulk of them were under $20 million. And I think the expectation is that I'm going to make an investment in a company, and then 2 years later, it's like an S&P or a real estate thing. I'm going to walk away a billionaire. And while it's true that the early investors in Google that put in 100K made billions, I think the expectation should be it takes 7 to 9 years on average for a company to get to the point where it either is going to have an M&A. So remember this, as an investor, there's only 3 ways to make money off of an investment that you make. Number 1 is if the company is acquired at a later date and you get bought out. Number 2 is if the company raises money in a future round, a Series A, a B, or C, and then they want to buy out the earlier investors. But I'll tell you, if they want to buy out the earlier investors, you typically don't want to sell, because that's when the company's just starting to take off and have its hockey stick growth. And then the third is an IPO. Now, I hate to break it to you, I'd be amazed if any entrepreneurs on this call have an IPO. And if you do have an IPO, please call me and rub it in my face in 5 years or 7 years, because I'd love to hear it. But the likelihood of having an IPO on a public exchange like a NASDAQ is very low. It's very difficult to do. So when you remember as an investor that those are the only 3 ways you make money. That's it. Dividend payments, those kinds of, there's lots of weird things that can happen, but I'd say as an equity investor, those are the 3 primary exit points for your investment. The other thing that I think is interesting is in Mexico, as I don't know if this law has changed, but in the United States, we're able to write off our losses against our gains. So if you make 10 investments and 9 of them fail, you can write off the 9 losses against the 1 winner in a tax efficient way. Now, I know that Mexico's been looking at changing that law, but that has a pretty dramatic impact on an angel and on a small seed fund, because if you can't write off the losers against the winners, your returns are going to go down. So if you're looking at starting a fund or a seed fund or a group of angels together, just understand the tax efficiency part of that. The other recommendation I would make is start slow. The last thing you want to do is, get a bunch of your friends together, start a group and do 25 investments in 2020. Maybe that would be a good way to go about it. But to me, especially if you're taking the vertical approach, do 1 to 2 deals this year and just learn. And then as you get more comfortable, you can scale up your investing and scale up the dollar amount. And the other mistake I've made, this is a great one. The smallest investments that I've made in terms of dollar amount have had the greatest returns. The biggest dollar investments I've made have gone to 0. So I think having some sort of structure and methodology around dollar amounts and ticket size for your investing, either do the same amount all the time or double down and follow on with later capital, but have a strategy in place that enables you to be systematic about it. And then the other thing that I think is critical is, once you make an investment, that's not the end, that's just the start. So I think developing relationships with venture capital firms is really important, because if you do a traditional angel round, it's going to be sub $1 million, especially in Latin America. You want to be able to avoid what we call the Valle de Muerte. No, you don't want to have a company that raises $500,000, pivots, finally starts to get traction into the industry that they're developing, starts to get customers. And what people don't realize is, when your company's successful and you're growing and you're hiring, your cash flow suffers. So if you found product market fit and you're developing a product that's doing very, very well, you're going to have to hire salespeople. You're going to have to hire customer support teams, growth. You expand to your outside of different markets and cities. It costs money. So even if your company's doing well, you can't rely on that seed round or that small angel round to get you through to the other side. So I think it's very important to understand which venture capital firms are likely to invest in the kinds of deals that you're doing. And candidly, I think for me, the best kind of deal is one where you involve everyone at the beginning. So for example, a seed fund, which maybe takes the board seat, which is 750,000. These are US numbers, 750,000 to $1.5 million. And then maybe 6 or 7 or 8 angel investors that are at the 25, 50, 100. So you've got a group together that's put the money in. They've got enough money to get them to the proof point that they need to be successful or not. And you've got a bunch of advisors and mentors and people willing to help the company built in. And so that you have a fiduciary, the seed fund, who's sort of, it's not herding cats. It's one person that has the fiduciary responsibility to help that company get to the next stage. Those are the types of rounds that I like to see the best. The blurring between friends and family, angel, seed it's sort of been blurred here in the US at least. So I think understanding where you're going, and I'll give a plug, I think Andy Kiefer from Agave Lab in Guadalajara has done a great job with this. So he started basically a seed camp, and he started funding some small amounts to companies. He developed an incubator. He developed a fund on top of that. But the one thing he did that I thought was brilliant was he got the executives from major companies, for enterprise companies, together to start talking about what they needed and sharing information, so that when he had a startup that had a product that was useful to one of those companies, he had a built-in customer supply feedback network. So he could bring his companies to these enterprises and say, is this product good? Do you like it? Is it useful? What do you like? What do you don't like? So we built that loop back in, and then some of those people become investors and customers. So I think developing that, one of the reasons Silicon Valley is so successful, in my opinion, is that there are lots of different stakeholders that all have the same goal in mind. So if you're an entrepreneur, you've got mentors that want to help you, and you've got investors that want to help you, and funds that want to help you, and Stanford and Berkeley and universities that want to help you, and banks, Silicon Valley Bank and others that want to help. So it's the whole ecosystem of all of these different players that are together, that are all trying to focus and march to the same goal. That's what I think the secret of Silicon Valley was. And that takes decades. That took decades to build. So anyway, those are sort of the off-the-cuff thoughts that I had about being an entrepreneur and raising capital, and then on the angel side. And I really do want questions. And if you guys want to, don't be shy. I mean, trust me, I've made every mistake there is, and I've been on both sides, and I've seen this. So if you have questions, please put them in the chat, or, speak up, and, I'll try to do my best to answer those, but hopefully that's helpful. And
Thanks, Mike. Those are really helpful. We're having 3 main questions in order to follow up with the next ones that we've been receiving here, and relevant to the entrepreneurship path, which I think we have more assistance from that specific mindset. We're having the question that how founders can make efficient use of our time during the fundraising, instead of just like, okay, I'm leaving the product development side to go and find my C round, and I really don't know if that the fundraising is totally having all my time, or how can I, well, at the end it seems like they're having the challenge in how they optimize the time, instead of just, I don't know, quitting from the product development instead of just fundraising.
Yeah, this is a tough problem. It's the chicken and the egg problem, because especially if you're writing code for your company, you go to raise capital, and that's a full-time job. And then everyone on the team thinks, what are they doing? They're not here. And then your sales drop off and your traction dips, and then it's less attractive for the investors. So that's a really hard, there's no easy answer to that. At that stage, you just got to work really, really hard. If you have a co-founder, that can be helpful, because maybe you can split and divvy up some of the responsibilities. The only secret I know to shortening the cycle of raising capital is to have customers and sales. If you have customers and you have repeatable sales, it solves a lot of problems, because what ends up happening is you have more money coming in, so that you don't have to spend your time just trying to raise by a deadline. The investors like it because they see that you've got product market fit and people are paying money for your product. So, really what I suggest somebody in that position, focus on your customers and focus on selling. It's a little bit different if it's enterprise versus consumer, it's a little bit different. But if the more success you have with customers, the better your due diligence will be with the investors, and the less money you need to raise, and therefore the less dilutive the round would be. there's nothing better than having cash flow from customers. And what I always recommend, this is a really important point, if you're an enterprise type sale and you sell on a monthly SaaS, go to your customers and say, I'll give you a 15 or even a 20% discount on our annual price if you pay it up front. If you can get customers to do that, that's a really good signal to investors, but it's also a good deal for the customers because they know they're going to get a good discount, and then you get the cash flow up front and it helps your expansion. So I think a lot of entrepreneurs focus on, customer acquisition cost and LTV, but what they don't look at is the timing of the cash flows. That's just, and in fact, the inflection point in the graph on cash flow up front versus cash flow over the course of a year can change the trajectory of your company. So there's no easy answer to that. Unfortunately, it's hard work. It's hard because you got to do your day job in the morning and then your night job at night. But I think communication with the team and letting them know about your fundraise process and what you're doing is important, and letting them know that it is a full-time job and that you're going to have to dedicate a lot of time to it. I think team communication is really important here. And then share your successes and your failures. Like, they need to know, how hard it is, what you're doing, and successes you're having, because then they can see it. So I just, not a great answer, but
it's great, Mike, actually, because we still have like that kind of sort of way of just understanding the balance. And I think that the next question is relevant to that specific answer that you provide us, because we mentioned that the importance of defining and tracking KPIs or OKRs to understand how effectively the startup achieve its objectives. How I don't know if they're asking this question relevant that the pre-word that we sent to them, it was some of the articles from the Y Combinator's startup library.
Yeah.
So what do you think?
Yeah, so for me, what I love that, because that breaks everything down to its simplest form. So I always ask the same question to entrepreneurs. What are the 3-5 KPIs that are most relevant to your business? What are the ones that we should track month to month? And what are the ones that matter? And I'll give you number one. Number one to me is cash in the bank, always, right? Number two, it could be, like I'm working with a company now in the retail space, and they've got a unique model where they're charging by a percentage of invoice. So what we track is the GMV, which is the gross market value. And then we also track the number of customers that are in this take rate environment. So it could be something like on a gaming app or consumer side, it could be what day does how many paid consumers do you have? What's the free to paid conversion? It could be churn. It could be dispersed geographic adoption of the product. But I think if you can understand what those 3 most vital things, the lifelines of your business are, then it gives you a window. And if you don't get the investment necessarily day one from an angel, and by the way, I always say, if you want money, ask for advice. And if you want advice, ask for money. But so when you have those KPIs and you know that they're the right ones for your business, you can share monthly, bi-monthly updates with investors. Most investors are like, yeah, I'd love to see your progress. Let me know how things are going. And if you have those 3 metrics that are really critical, then I can see them grow over time. Like, oh, wow, this the delivery app, they had 20 merchants, now they have 200. Or they delivered 20 products and now they've delivered 1,000. Or the average price, like in the corner shop, the average price per delivery started at X and now it's Y. So I think, and this goes for the financial models for your business too. I think what's more important than the numbers that are on the page or the numbers on your presentation is the thinking behind it from the founder going into it. So I've seen thousands of business plans over the years. I don't think any one of them were actually on the mark. Most are below or some are above, but it's the thinking of the founder to create that financial model that shows me how well they understand their customers and that shows me what the potential growth is rather than the absolute numbers themselves. Because some businesses take a lot of money to grow slowly, and then they grow a lot. Some take a little bit of money and grow quickly. I just want to understand that you understand the model. You built it. You didn't hire some third party to put it together, and you don't understand the numbers. We're looking at the thinking, not the absolute numbers.
I think that's pretty relevant to the next question that we have in with the. You know that a lot of founders are like, okay, how can I ask for a referral from other founder if I already know some information about the investor or the venture capital fund? And they ask us how can they ask for referrals from other founders without being a weird stalker?
Yeah, no, I think you hit on a really good point, which is the best introduction to a venture capital firm is from one of their existing portfolio companies that did well. I think you'll find, depending upon the stage of the company, I think you'll find that founders are pretty willing to talk. Obviously, if they get big, and it's probably going to be hard to get a hold of Eric at Zoom nowadays, right? But I think maybe their departmental head, maybe the head of customer service, or maybe the head of another department. I think founders get it. I mean, don't be shy. You don't want to just send out a blast to 100 founders and say, let me talk. You got to be very specific and targeted with your approach. So something to the effect of, Deborah, I noticed your company is in the same space as mine. I think I could learn a lot from you. I promise not to, take up too much time, but I had these specific questions. I don't think you should directly ask Deborah for a reference to her VC firm, but you start with, hey, would you be willing to talk with me? And I think what you'll find in Latin America in particular is if there's a US company, and you guys are lucky because you're in Mexico, I think, most of you. Mexico's a big market. And most of these founders that are developing their markets here in Europe are thinking down the road that Mexico would be a good market for us to enter. So if they get a call from an entrepreneur that actually is in the market from there, doing a similar product, it could be an interesting conversation because, oh, well, how does that work in Mexico? How does that work here? Maybe it becomes an acquisition down the road. I wouldn't be shy about that, but don't expect, don't ask people for referrals if they don't know you. That's just, nobody's going to do it. But if you build that relationship and you're respectful of people's time and you're very direct with why you're talking to that person and what their value is and what you're doing, I think that, like a good example is I'm working with, you probably know it's an insurance company in Mexico, and they've got some access to some folks in the insurance industry in New York. It's interesting. Like these New York insurance experts are all wondering, what would it be like to expand my company in Mexico? How does it work? What's the insurance? So I wouldn't be bashful, and I wouldn't mind, I think if you send an email and there's no response and you can follow up and just be nice, obviously you don't want to send 8 emails and, just understand the situation. But I wouldn't be bashful about sending that first email and following up. I mean, what's the worst that could happen? They ignore you. So what?
Yeah. And I think that question is totally relevant, that here in Latin America, we're still working on it, on trying to understand that when you're starting with the fundraising process at your company or your startup, it's not like right now and we are gonna to expect the fundraising round to be closed in the next week. So I think that kind of mindset have us the rush to just writing people and like, okay, give me a referral because I wrongly think that the next month I already gonna have the next round secure from some of the investors.
Yeah, but I think here's an important thing too, is like I said earlier, that a lot of these VCs blog and write, so you can get a glimpse into how they think and what types of things they're doing. So if I get an email that says, hey, Mike, can I talk to you? Here's my startup. And it happens to be all the time, right? And the startups maybe in the travel space, and I don't do anything in the travel space. So why are you sending me this email? But then I also got an email from someone who said, hey, I noticed you invested in this company and this company. We do the same thing. Here's our market. And I noticed you spent a lot of time in Latin America. Would you be willing? And this was pre-COVID, but by the way, I'm going to be in Silicon Valley from this day to this day. can I meet with you for a half an hour to discuss? Yeah, I took the meeting because the person did their research. They understood the types of things that I invest in. They knew where I lived. They knew what I did. And, it was very respectful. Yeah, of course I'll take that meeting. And I think you'll find that most investors will do that, but don't go to an investor to have there's nothing worse than the following email. Can we get together for a cup of coffee? I want to pick your brain. These guys are busy. I mean, I'm sure Santi, I don't know if they go through the numbers, but they get 15,000 submissions a year. They look at 150 deals. They do due diligence on 40. They make 1 or 2 or 3 investments. They don't have time for a cup of coffee. So if you're in the window of a 90-day fundraise, yes, say that. There's nothing wrong with being direct, but don't try to be indirect. That's the other thing too, is Americans can be fairly direct. And I know that sometimes culturally that's, you don't want to be boastful, but you don't want to omit information that's valuable because you have one chance to have that conversation. So if you've done something great or you've done something relevant to your fundraising and your company, say it. It's okay. You're not bragging. We want to hear it. You get one shot at it, one pitch at it. And I think that's okay. You know what I mean? I think that's not the time to be humble. You don't want to be boastful and a braggart, but I think any information that's relevant to a decision that an investor is going to make about your company, you should include.